Welcome. I'm Andrew Camden. I'm a long-standing board member of the Community Foundation for Southeast Michigan, and it's my pleasure to welcome you here today. This is an exciting thing because we want to talk about the impact of the new tax legislation and how it impacts nonprofits. Many of you have worked with the Community Foundation over the years, and we want to cultivate and encourage that. And I would like the members of the staff who are in the room to please stand and identify themselves, know them by name, and you can seek them out as time goes on throughout the day. Randy, why don't you start?
Randy Ross, Philanthropic Services.
Charitable, Philanthropic Services. Karen Lebanon, Finance Administration. Melissa Smiley.
Collins, Digital Marketing.
I guess Robin Kirby, Philanthropic Services. Hi guys.
and we'll introduce Miriam in a minute. You may also know about the grant-making opportunities that the Community Foundation does in all the very many organizations that we support. But you should also know that we strive to build civic infrastructure of this region through the free educational opportunities we offer, like today. Today we have had 300 people here at the DAC to listen to the presentation, and these were all nonprofits. And one of the things that I've watched over the years is how we have developed strong relationships with the nonprofits that we work with to help them in their fundraising activities and properly stewarding the money that they have. Now it gives me great pleasure to introduce our president, who has been our president from the beginning and is in many ways, she'll deny this, but I will say it anyway, responsible for the phenomenal growth we've had over the years and how our reach has become so impactful. Mary Millman.
Well, I want to thank Andrew. I deny it because we have the best board in the whole world, and Andrew's been a long-time member of the board. I want to thank all of you for coming. We knew that when the bill passed in late 2017, it would be important to convene the nonprofit organizations and tell them what to at least be aware of. And we thought it would be a great opportunity to convene you all as well. You heard that we had a large crowd this morning, and so we live streamed, and we already know that it's had a broader reach. We're live streaming this as well. If you want to text out to your colleagues, if they want to watch it, just direct them to, and it may be on the screen, cfsem.org, I think is the right way. And I'll be corrected if that's wrong. So please feel free to do that. I would also give a special thanks to staff. We did do this very quickly. Robin and I said, here's a date, we have Ruth, and then the staff had to make it happen. So many thanks to the staff. It's my pleasure to introduce to you Ruth Madrigal. You have more information about her background at your places, but she's really the perfect person to start this conversation, and we saw that in action this morning. Ruth is a partner at the Washington, D.C. based law firm Steptoe & Johnston, where her practice involves advising on a variety of legal and tax policy. Used to work at the Treasury Department and policy advisor in the Office of Tax Policy. Please read more about her in the background. She's going to speak a while. Then Robin Farabee, who most of you know, Vice President of Philanthropic Services, is going to lead her in questions. If you would want to text your questions to Robin, you see on the screen, if something comes up, he's going to keep track of those, and he'll use them off the discussion. Introduce Ruth to you. We appreciate all that you're doing for us today. Ruth back.
When I first I was at Treasury for 6 years, and I spoke all the time to a lot of folks who create that have been reviewed for months and months. And so I am still learning how to speak again with a clicker in my hand. So if I get behind, just shout at me. I've titled this, The Tax Act of 2017, What Just Happened? A lot of people are asking that. I'm asking that. So as we walk through this together, that there is a lot that we don't know about this tax act. There is no guidance. There is just a massive statute that got passed in, and we're trying to figure it out. So I'm going to give you what I know at this point. It's not tax advice. I'll give that disclaimer. We're just going to do some explorations, and I'll share with you observations. Dig into this statute. It is what's very clear to me is that the more you look at any given provision, the more you will find, and you will start to find the gaps and the holes in this legislation that will need to be filled in and fixed through the regulatory process. So this is a first look at the Tax Act. And we'll start with a little overview. You might have wondered why I'm calling it the Tax Act. For a long time it was referred to as the Tax Cuts and Jobs Act. Jobs part might have been hoping and wishing. Certainly tax cut is a major focus of this legislation as a bill, because it was not germane to the budget. It did not, everything in this bill, because it was passed through a process called reconciliation, had to be germane to the budget, to raising funds. And apparently the short title was not germane. The bill's title is now given there for you, and nobody uses the bill's title for obvious reasons. So I will refer to it as the Tax Act, the Tax Cuts Act, HR 1, all of those are the same thing. As I said, it was passed through reconciliation so that it could pass through the Senate on a bare majority vote instead of the usual 60 votes that's required to avoid a filibuster. It was and it was a very speedy process for a tax bill. Tax bills usually take years because there's lots of provisions, and the tax lawyers are into the details, and they like the provisions to cross-reference appropriately, and it usually takes a long time to draft, sit down and draft it. This was done. First look at the bill language on November 2nd. With two big drafts, the House bill and the Senate bill, that were not at all the same. Or Tuesday or Wednesday, and then signed the following Friday. It was very, very fast. So, all that to say, it doesn't all make sense. There are rough edges in this bill that even the best lawyers, and I know we have good ones working at the Joint Committee and on both sides of the Hill, that kind of as I start to look at various provisions that affect charities, I'm finding gapes and holes, and I'll point a few of those out to you today. This is where the next steps in the process become really important. The regulatory process is where you fill in some of the gaps, where you interpret some of the provisions, this provision that says X and this one that says not X, and you have a regulation that makes sense of these provisions. And so the regulatory process is going to be the focus. And I want you as to participate in this regulatory process. And I'm going to say right up front, the punchline to this whole presentation is get involved, to be involved in all low-income your beneficiary. Do the same. issues and individual issues. They would have people coming in, pounding on their doors and saying, this statute, this is terrible, we need guidance and you need to fix it. And you need to do it yesterday. And by the way, this shouldn't be effective and you need to delay the implementation date until you issue guidance so that we can follow it, because we don't want our shareholders to be out any additional dollars. My people will come in and say, you know, I know you're really busy and we really appreciate all the things you do. And we know that you've got a lot of things on your plate, but if you could possibly see your way clear to help give us some guidance on this as soon as you possibly can, we'd really appreciate it. And that's really nice. But how well did that work for you? Where are the donor advised fund regulations from the Pension Protection Act of 2006? And how much money has been spent in administration costs of trying to figure out how you can be on the right side of that was also immediately effective? And here we are 10 years down the road, and we have no guidance until the notice just last month, but I can mention that later at the end. You have to get involved in this, because the dollars that you spend in taxes, if you spend extra in taxes and extra in administration, it's less dollars to program. So you need to see this as a program issue. Let's see here. Yeah. Is that the tax rates? Rate cuts, yes. Make sure I'm on the same page with you all. I'm going to give a very broad context first before we get into examining the individual provisions of this bill that affect charities. And the context is important because this is what this bill was really about. It was about rate cuts. Corporation rate goes down to 21%. That's true across the board for those of you that pay UBIT taxes at the corporate rate. Instead of 35% on the margin, it's down to 21%. Partnerships get a 20% deduction off the bat if you're a certain kind of, for certain kinds of pass-through business income, but not if you're lawyers, accountants, consultants. If you're an architect, you're fine, or an engineer. This is a complicated provision, and I've got, fortunately, a partner that does partnership taxes and trying to figure out what that means. But the bottom line is they were trying to give a break on partnership business income, which is taxed at the individual partners' rates, that in some way was similar to the tax cut going to corporations. It temporarily lowers rates and expands brackets for individuals, and so many of you have probably seen this. The bottom rate stays the same, so folks earning under $10,000 of adjusted income, taxable income, still at the 10% rate, but all of the other rates have come down anywhere from 0.5 percentage to a couple of percentage points, except for the 35% rate, which is still in there and about the same place in the brackets. But the brackets have kind of expanded so that there's more income being taxed at the lower rates. It's weird, it's not at all symmetrical. I think a lot of the jockeying with rates and brackets had to do with paying for this. The combination of these tax cuts, along with any sort of increases in pay-fors, couldn't exceed $1.5 trillion. So the combination of this bill costs $1.5 trillion. And the hope is that that will be made up for in economic growth. I note at the bottom the trust trusts are still taxed at individual rates, which may be important in a context if you are a trust rather than a corporation. But the temporariness about the individual rates leads to some interesting things throughout the bill, and I think that was due in large part to the need to stay within that mere $1.5 trillion budget. Before we get to individual provisions for charities, I did want to take a moment and talk about the big picture impact on a number of folks that may be your charitable beneficiaries and the folks that charities serve, and that's the lower income folks. I've given you some long quotes, mainly so that I could also give you the citations to the Congressional Budget Office and Joint Committee on Taxation reports that these came out of. These are some studies that are required by law to be done or have been requested by particular senators or congressmen on the impact of the tax bill. This one came from the Congressional Budget Office, talking about the distributional effects of the total tax bill once you got it all put together. And I'll read it for you and then I'll interpret it for you. It says, overall, the combined effect of the change in net federal revenues and spending is to decrease deficits, that is, raise money, primarily stemming from reductions in spending allocated to lower income tax filing units. That's people. And it will increase deficits, meaning take money, primarily stemming from reductions in taxes allocated to higher income tax filing units, people. So the overall, what the Congressional Budget Office is forecasting as the net effect of this bill is to raise money from less spending on low-income people and increase the deficit due to reductions in taxes on higher-income people. It's that first part that I really want you to focus on a little bit, the lower-income folks having less spending. And how does that happen in a tax bill where across the board, at every bracket, the average of tax paid is lower. And there are distributional studies done by the same folks that show that for each bracket along the way, the 10% bracket, the 15% bracket, the folks at every income level, on average, have a tax cut. And the reason for this is given in the next slide, the JCT report. The reason for this is that the tax cuts on the low-income people are small, as one would expect, because they don't pay a lot of tax. But the impact of the eliminating the penalty associated with the individual mandate ends up paying for about $300 billion of the tax cuts across the board. And how that raises money, which I scratched my head at first, is like, how does that raise money? JCT explains it. It says, mainly, fewer people will be enrolled in Medicaid and non-group health insurance. Healthier people are less likely to obtain insurance if they're not going to be penalized for not having insurance. So when the healthy people pull out of the non-group pool, the pool of folks that are buying insurance because it's not provided by their employer, the healthy people pull out, the costs for the pool go up. And those costs have to be spread among fewer people, so the premiums rise for the people that are left. The lowest income people in that pool no longer can afford to pay the premium, even with the incentives that are given and the credits that are given by the federal government, so they stop buying insurance. The federal government stops paying those incentives. Also, so they forecast that there will be lower costs for the feds for premium tax credits and for Medicaid, though there will be a slight bump up in Medicare spending for hospitals that serve low-income people. And that's a window onto the larger effect for that charities, I think, need to watch out for, is the impact on the low-income folks in the communities that you serve. Because if you are the hospital serving low-income folks that no longer have insurance, you can bet there's going to be an impact on your operations as these folks come to you as the provider of care of last resource. So I think that charities need to look at their operations and maybe think about what are the impacts going to be on my operations, on my program side of some of the changes that come from this bill. The next slide is, you probably can't see it very well. These will be available for you after the presentation. But this shows that primarily it's a table showing at different categories where the net benefit is, and it shows that at the bottom income categories, the loss of these federal subsidies outweighs the tax benefit, basically. And that as time goes by, each year, there's less benefit at the low-income levels, and that level keeps climbing until out in 2027. The bracket that goes from 50 to 75,000, they're actually in a worse spot than they are now in total. So I'm going to flip over, though, to more of a standard tax lawyer role, looking at tax provisions that apply to you and charities and how those have changed and how those might impact you. Charitable contributions was the one that was first and foremost on everybody's mind throughout the run-up to this bill being passed. Everybody knows that the standard deduction doubled, went to $12,000 for singles, $24,000 for joint. The charitable contribution deduction is still there, but it is expected that fewer people will use it because there will be more people that are using the standard deduction and fewer people itemizing. The estimate is that instead of having a third of taxpayers itemizing, we will now have about 5% of taxpayers itemizing. And part of that is because the standard deduction doubled, though no, the personal exemptions went away. So for folks with more than 2 children, I'm not sure that it all worked out in your favor. But it also reduced or eliminated a lot of the other itemized deductions that would add up. And often if you were already using up your itemized deductions up to the level of the standard deduction, then charitable giving was all additional benefit on top of those things that you already had to pay for, like your mortgage interest or your state taxes. Under the final tax act, mortgage interest is limited to $750,000 instead of $1 million. State and local taxes, famously $10,000. Note that there was significant lobbying that got the medical expense retained and even dropped for 1 year the threshold for being able to claim those to 7.5%. And the Tax Act eliminated the P's limitation on deductions. This sort of goes to the benefit. It means you get to use all of your itemized deductions instead of having that 3% haircut that the P's limit previously had. So if you do itemize, you're better off itemizing, but fewer people will be itemizing. And that was the source of concern. There are a number of studies that show a couple of things. Number one, when rates drop, the tax incentive from an itemized deduction, the incentive value drops because the marginal rate doesn't give you as much benefit when it's lower. So charitable giving drops. There are a number of studies that show that. It's not clear what exactly the impact is. Robin's got some data that he might share with us later about your own experience here in Michigan with the Michigan credit. But it's pretty much uniform for every study over a long period of time that when the tax rate drops, the giving has an associated drop. It's also, there's a lot of concern that when folks are no longer itemizing, and they know they're not itemizing, that incentive value is a lot less, and it's not clear how much that's going to impact the charitable giving, but there are some studies out there that shows that the drop is fairly significant. Folks were arguing for a universal charitable deduction, an above-the-line deduction, to try to avoid that impact on charitable giving, and my understanding is there was not a philosophical objection to it on either side of the hill or on either side of the aisle. I think there are folks from both parties, and both on the House and the Senate, that like charities and like what you do in your communities. But as a fiscal make the numbers work matter, you just couldn't give the type of tax cuts that folks wanted to give unless you could pay for it, except for $1.5 trillion that we're apparently okay. But folks were scrounging for pay-for-its, and the universal charitable deduction was just too expensive. What folks did do, temporarily increased the AGI limit for cash contributions to public charities from 50% to 60% of the donor's AGI. Most of us in the tech sector say, how many people were really pushing up on that 50% limitation anyway? But there's a bone, charitable organizations, 60% donor limitation that's temporary. A lot of these provisions expire in 2026, along with the rate cuts for individuals, because they had to make the numbers work. They had to stay within $1.5 trillion, and they had to make sure that there were not budget effects outside the budget window in order to use that reconciliation process we mentioned earlier, in order to be able to pass this through the Senate with only 51 votes. Another thing to watch out for, this is a trap for the unwary. Number 2, it eliminated, this was a budget proposal in a prior administration, and this is something that has been talked about. You know where colleges and universities, if they have a really good sports team, and tickets to those events are really hard to come by, if you have to give a contribution in order to have the right to buy those tickets at face value at some point in the future. So it's basically, if you give a contribution, you can stand in line first and you can get those tickets. If you don't give a contribution, sorry, you're out of luck, because all those people giving the contributions will get the tickets. Funny thing that there was a provision in 170L that said, if you have that sort of situation where all you get in return is the right to buy tickets to a sporting event, well, you can deduct 80% of it, and the other 20% is going to be the approximate value of that right. Over the years, funny thing, the face value of those tickets, as those teams got popular and NCAA started being broadcast and the people wanted to go, the fair market, the face value of those tickets kind of stayed low, but the value of the donation that you had to give in order to buy those tickets kept going up and up and up, and there are several that are in the tens and $20,000, $30,000 minimum contribution in order to get the right to buy the tickets that are $25. Starting to look a lot like a seating license. Congress eliminated that. Basically, the provision says if you give a contribution and you get back the right to purchase tickets at a college or university event, 0. Your contribution is 0. That's a trap for the unwary. It's not saying what the value is, it's not saying you reduce it, it's 0. So be careful of that provision if you or your clients are colleges and universities. Doubles, last bullet is, there's also in the estate tax, there wasn't a lot done with the estate tax. Some people wanted to repeal it. That was too expensive. So what they did was bump up the exclusive estate, gift, and generation skipping taxes. They doubled it, and it's about $10 million, and it's indexed for inflation. What this does, though, is provide less of incentive for charitable giving. If your estate is no longer subject to tax deduction for charitable giving is not really an issue, and so that may also impact charitable giving. Moving on to some of the other provisions of the bill, there are a number of taxes on tax-exempt organizations included in this bill in order to pay for the cuts for corporations, individuals. And that gets me a little riled up because we're the tax-exempt sector. There are good reasons that we get our tax exemption that are related to the benefits that we provide for our communities. And this bill, flat out, puts some taxes. And so we're going to talk about each of these in turn. There's some in the unrelated business income tax provisions. There's an excise tax on employee compensation. And there's a new endowment excise tax for certain colleges and universities. And lest you be tempted to say, oh, I'm not a college or university, I can check out there. First, they came for the colleges and the universities, right? This is an endowment excise tax. If you have an endowment, you should be paying attention about it. Start with the UBIT. UBIT provision on fringe benefits. It's not the biggest impact, but in terms of dollars, but this one can impact every single organization. Every charity, every organization, C4, C5, that is subject to UBIT. There's a new section there, 512A7, and it increases the unrelated business taxable income, the income on which you pay tax, by the amount that is paid or incurred for certain fringe benefits if those expenses are not deductible by a taxable employer due to Section 274. So what's going on here? Number one, this is kind of weird to me because it's a tax on the amounts that a tax-exempt organization pays to its employees for certain fringe, or for the benefit of its employees, like for parking or for qualified transportation benefits, like the metro passes, those sorts of things. It's a tax on those, which is not unrelated to the doing of their exempt activities, right? These employees are doing their exempt activities. They're not doing business activities, and it's not even income to you. It's an amount paid. Nevertheless, it's in the law now. That's unrelated business taxable income if you provide certain fringe benefits. Which ones? The qualified transportation fringe benefits. Any amounts paid for a parking facility used in connection with qualified parking, and on-premises athletic facilities if any of these benefits would not be deductible by taxable employers. The rationale here was seeming fairness with corporations that were denied a deduction for certain benefits under 274, namely the qualified transportation fringes. Here, though, there's an apparent mismatch of the non-deductibility of 274 and the unrelated business income, which leads to some funny things that we really need some guidance to be able to apply this. It's very clear that transportation benefits like metro passes, or if you pay for the parking for your employees in the garage next door, that's non-deductible for taxable employers. It is taxed, it becomes UBIT taxable for tax-exempt employers. The athletic facilities, there's a little provision in 274E4, so that even though the UBIT statute says athletic facilities taxable, in 274, taxable employers are able to deduct amounts paid for on-site gyms if they meet certain non-discrimination rules in that provision. So if your gym is open to everybody and not just your executives and meets this 274 exemption, then you won't be subject to tax. That's the takeaway here. So most gyms for tax-exempt employers, I would guess, would meet those non-discrimination requirements and would not be subject to tax. It's not 100% ironclad. That's what it looks like. There's still ambiguity because 512 talks about Treasury writing regulations to tax the depreciation amounts that are applicable to these facilities and to parking facilities. So there's also, but because they're not, that it's clear that these certain kinds of gyms are still deductible by the taxable employers, you all should be good. Parking facilities. When you're thinking about calculating your taxes, what are the reasonable provisions here? And amounts paid in taxes are amounts not paid to your charitable beneficiaries in your programs. So I think we should demand guidance before we have to pay amounts to the federal government that would otherwise go to our charitable beneficiaries. UBIT, separate calculations for separate trades or businesses. This could have a significant effect. It basically, under prior law, when you calculated up your unrelated business income, it was sort of like taxable businesses calculating their taxable income. You looked at all the income from all your different lines of business, took out all of the expenses. If there was net income at the bottom, you paid tax on it. If one business line was a big loser and it sucked up all of the income from your profitable lines of business and you had a net negative overall, you didn't pay tax. For UBIT calculations from January 1st going forward, you calculate your net income for each individual unrelated business separately. And then you add up all of the positive amounts and not the negative amounts, and you pay tax on that total. So you can't use losses to offset gains in other businesses. We really need guidance on how to draw the line between separate lines of business. This was aimed at, I think, colleges and universities. I'm sorry, colleges and universities seem to have been hated by Congress this go-around. They have, for example, rental of facilities and sales of tchotchkes in their bookstores and various lines of business that, and so drawing lines between those and adding up, that makes some sense. Where this really has a rub for a lot of you and your clients will be on investment income. If you invest in alternative investments, which are often partnerships, right, flow through and the typical tax-exempt principle that if you're a partner in a partnership, you're doing the activities of the partnership. Most of these alternative investment vehicles have partnerships that cascade down. You might invest in a master partnership that then has 10 funds underneath it, and each of those funds then invests in portfolio companies, some of which are corporations, but some of which are LLCs. And so you could be treated as doing the business activities at the bottom. And that income flows up to you on K1s upon K1s. And there's also debt-financed income in there sometimes too. Those all flow up. So what is the separate trade or business lines that you're required to separate and calculate income on in an investment situation? Is it the one activity of investing? Well, I like that answer. That makes it pretty easy. You just sort of add up all those K1s. But as an accountant that I was talking to last week was saying, what do I do with this 150 K1s that my client has? Do I have to separate it out each by each fund? Is each fund a separate trade or business? Do I have to look beyond that and look at the portfolio companies? Do I have to clump them together and try to somehow manage them that way? This is one that definitely calls out for the sector to say, we can't comply with this unless you delay the effective date and give us some guidance on how to do this. And more than that, a strong suggestion that investing should be one bucket. It's not really a trade or a business unrelated in the same way that rental of facilities or sale of goods or advertising. This is supporting your mission, and the administrative cost of trying to sort down could be enormous. So that's one, again, if you're inclined to input into this process, you should be. Guidance is definitely needed, and it would be very helpful if all of investing was one trade or business. Next thing I want to talk about a little bit is executive compensation. There's a new excise tax, 4960. It imposes a 21% excise tax on an employer with respect to certain amounts paid to covered employees. It applies to compensation in excess of $1 million. It would be a tax on the amount over $1 million, and certain excess parachute payments. And parachute payment is a payment that's made on the condition of separation. It applies not only to C3s, but to all organizations exempt from tax under 501A. Those are 521s, to political organizations, 527s, and to organizations with income excluded under 115. These are governmental instrumentalities or affiliates, where 115 is the exclusion for income that is related to a government purpose. Covered employees quickly include any employee that's one of your top 5 in the tax year. And once you're a covered employee, you stay a covered employee forever. So, and it started as of 2017. So your top 5 compensated employees in 2017 stay covered employees, even if they're not the top 5 in 2018, and you keep rolling list. So your list of covered employees will grow over time. And you have to be concerned also about compensation paid by related entities. Make a few notes on this. Compensation. Services that are performed, including amounts that are paid once they're no longer subject to a substantial risk of forfeiture. But there are a couple of interesting exclusions, I should note. Amounts that are paid to licensed medical professionals, and that would include veterinarians, For the performance of their medical or veterinary services, those are excluded. I think folks heard the fact that, you know, a lot of surgeons and medical doctors are performing services in hospitals, and you want to pay them the amounts that are paid commonly, and it will be very difficult to attract talent if you can't. And I guess someone in Congress didn't want the doctor at his local nonprofit hospital to be the lowest paid person in town. Because this just brings us to a point. You should bear in mind that the idea behind this was not some sort of grand, oh, I don't think charities should be paying more than $1 million. It's not a cap. It's not a flat requirement that $1 million is too high for any charity to pay. And it's not a provision about unreasonable compensation. We already have provisions that deal with that. 4958 requires all compensation paid to be reasonable and fair. But that allows tax-exempt organizations that compete with for-profit organizations for employees to pay comparable amounts so that they can attract the talent. And you want that in your doctors, obviously, but you also want that in your managers, you want that in your investment professionals, you want that in your tax-exempt sector. Now, the reason for this provision that was floated was, well, this is just fair. This is just fair because on the taxable side, under 162, 162M makes compensation over $1 million to the top 5 compensated employees of a publicly traded organization non-deductible. So in order to be fair, we have to do the same thing on the tax-exempt side. But you guys are just like publicly traded companies, right? And you only compete with publicly traded companies, not the non-publicly traded taxable companies, right? Those folks don't have any cap on their compensation, and they can offer incentive compensation like stock options that you all can't do and often have to make up for with a little bit more salary. So this fairness argument does not fly in my book. It just seems that the tax-exempt sector was a very easy target with an unorganized lobby that did not effectively get this stopped. It's unfortunate. I'm not going to talk about excess parachute payments. I'm just going to skip on because in the interest of time, I want to get to some of these later slides. This one is excise tax on. The endowment income one, things I want to point out here, it's a 1.4 excise tax on net investment income. Flat out, it's just a tax on endowments because they were there and they could pay for it. It was one of the biggest revenue raisers in the Camp proposal from a few years ago, and it got picked up. The exact contours of it I have for you here in the slide. An educational organization has to have at least 500 students, 50% of whom are located in the United States. It has to be a private, not a public institution, and it has to have assets of at least $500,000 per student. The gotcha here is that, let's see, is it on here? Yeah, the second bullet, the excise tax and the assets, when you're trying to figure out that 500,000 in assets per student, you have to take into account related organizations like supporting organizations and controlled entities, even if those are for-profit controlled entities. And I know of situations where you have a supporting organization that is really big, maybe a couple of $1 billion, that provides support to a lot of community organizations, including a college or a university. If that college or university, for example, gets $50,000 a year to set up a musical night on campus, but that organization has $2 billion in it, that college or university, because they're a supported organization to that, they're supported by that supporting organization, they would be related. And all of that supporting organization's assets would be considered as theirs when they're determining whether they meet that 500,000 per student threshold. And all of that supporting organization's investment income would be considered as theirs when they're calculating how much tax they owe. And that could be a huge trap for the unwary, because that college or university may have no control over the amount of cash that they actually get out of that organization. That's a big trap there. Be careful. Flip on. Sorry, I'm having trouble flipping my slides. Qualified opportunity zones. I wanted to take some time to explain these to you because if there's anything good in this bill for charities and charitable communities, the qualified opportunity zones have a promise of a silver lining. There's a couple of new provisions, and it's at base, it's intended to be an incentive to invest in distressed communities. They're being called the qualified opportunity zones are the ones that are going to be the targets of this investment. And what it does in big picture is it provides investors with tax incentives and benefits if they take gains that they are realizing from another investment and roll them over into investments in qualified opportunity funds, QOFs, within 180 days of the sale of that prior investment. So you sell something, you take that gain, you roll it over into a QOF. The QOF invests in these qualified opportunity zones, which are low-income communities that have been designated by the state and the Treasury as such. If you hold, the benefit to the investor is that you exclude it from income in the year that you ordinarily would have had it, you exclude it, and you don't include it in income until a later year, like when you sell that QOF investment, or 2026, which is the midnight and the pumpkin turning into hour for a lot of these provisions. So you get to defer the tax on that for quite a bit of time, and there are additional benefits the longer it's held, that QOF investment is held. So on a flag for you, the first step is designating the QOFs. The big thing here is that the governor has to identify them and nominate them in his state or her state within 90 to 120 days. It's baked into the statute, these time periods. I don't know yet how much flexibility there is in that, but there is a real premium on moving quickly in your state to identify the qualified opportunity zones. And these have to be low-income communities. It's tied into the definition with low-income housing. They have to be nominated. They can nominate up to, every state gets at least 25 clauses. If you have more low-income communities in your state, you can nominate more clauses. Treasury has to act on those within 30, maybe 60 days. They've got some extension provisions. It's not very fast. This is the time, and the clock is already ticking. So we have to move on that very quickly. Guidance is probably needed on this very quickly. Moving on to the benefits. Second step, you got to invest in it. You got to get the word out to investors. And here's some more detail about what these are. A QOF is a fund that has purposes investing in quases. And they have to hold 90% or more of that. And there's a penalty if they don't. This gives you a little bit of definition on what is quasi property. Let's get to the benefits. So you exclude it in the original here, and then you include in income in a later year, either when the QOF is sold or 2026. And so I've given you the calculation here, but the bottom line is that if your investor turns around and sells that QOF interest after a year or 2 years, then they recognize the amount of the gain in that year that they sold the QOF. Or if the QOF has declined in value, so that maybe you put in 100 and now it's at 50, you only recognize 50 in gain. And that makes sense. But if they hold it to 5 years, if they've got this thing for 5 years, then they sell it, they only have to include in their income 90% of that originally deferred gain. So there's an additional benefit there of 10%. And if you hold it 7 years, well then you're including back into income only 85% of the deferred gain. So you've got some additional benefit there, as well as the potential benefit from the QOF itself. This QOF may not be declining in value, it may be increasing in value. And that benefit, there's an additional benefit here that if you hold it for 10 years, then the basis in the QOF, when you sell it, is the fair market value at the election of the investor. So there would be no recognition of the additional gain above what you dumped into it. And that's a significant benefit. The one trick here is, again, to make these numbers work and to stay within the reconciliation rules. December 31 of 2026, that's the pumpkin hour. They had to, you have to recognize your gain in 2026, even if you haven't sold your QOF. The deferred gain gets recognized in 2026. It's included in the basis that you have in the QOF, and you can continue to hold it, and you can continue to march toward that 10-year date so that any of the gains in the QOF are not taxed. But all investments in the QOFs, in order to qualify for these benefits, have to be made by the end of 2026. So that one is one that's also temporary. We need guidance at Treasury. It's going to be I think this is one area where we really need guidance and we really need it fast. And I think I hope there will be an effort. And someone earlier asked, well, how do we get involved in this? And I'm pointing at the Community Foundation, the Council on Michigan Foundations. They can give you information about this. A couple of other provisions. I'm going to pass by this. It just basically, if you were afraid of that donee reporting possibility from a few years ago, no need to worry anymore. That provision is eliminated. There's no chance that you will have to report your donors' contributions on your 990s. The private activity bonds, there was a proposal to get rid of those. That came out, so you're safe, but the advanced refunding bonds, you have to include that interest in taxable income, so they're no longer tax exempt. There are a bunch of near misses that you can review. These slides will be available to you. These provisions were things that were proposed, were in, came out. For the most part, that's good, because a lot of these things were kind of scary. But since they are in legislative language, they may come back again. And to the extent that they raise revenue, be careful. Could raise revenue on you. And in particular, I think that endowment excise tax is really dangerous. The only reason for it is because they wanted money to give tax cuts to taxable parties. That could be your community foundation. That could be your private foundation endowment. That could be anybody next. So we really need to be vigilant about protecting the sector. So that's that. We'll move on to questions, if that's okay.
Is Puerto Rico, is that included in Quad?
Puerto Rico, actually, there was a late addition to the bill, and all low-income census tracts in the territories are automatically designated as qualified opportunity zones. So the territories appear to have, they had somebody looking out for them. But in all the states and in District of Columbia, you have to designate.
So hi everybody, Robin here. As a reminder, there's a text number where you can text in questions with those that are here in the room. You can also just ask and someone come over with the mic and we'll answer the questions as best we can. I got kind of set up here to talk a little bit about elasticity and what this might mean for charitable contributions. A lot of you advise nonprofits, so hopefully this information is good to take back and start talking to nonprofits about their employee benefit plans and things of that nature, but also how they talk to potential donors. But you also have a lot of personal clients, and how does this affect their charitable deductions and their charitable contributions? So what Ruth mentioned about statistics that I know is there's studies that are relate to what is called tax elasticity. And it's the change in the tax value of a deduction, how that changes actual behavior. Okay? What those studies have tended to show is that for every 1% change in tax value, there's a 1.2 change in behavior. Okay? A few years back, we all recall that we had the state of Michigan tax credits. So it gets like $200, a person can get a $100 credit, $400 for a married couple, you can get a $200 credit. If you think about that, that's a 50% credit. When those were repealed, CMF and MMA did a bunch of studies, and we went to those nonprofits that were eligible for that and said, how much did those size gifts go down or up the following year?
And what they did found was that they went down, I think it was around 63%. 50% times 1.2 is 60%. Okay. So kind of bears out and proves what that elasticity factor had shown. So Ruth talks about the fact that you're going to see a lot fewer people being able to itemize. It was from 30-something% of taxpayers down to 5%. They're giving up that tax benefit by not, of the charitable deduction by not itemizing. Likewise, if you have someone that is making a gift and they're at a tax bracket that's gone down, if their tax bracket's only gone down 5%, but times 1.2, they change their behavior by 6%. So that's kind of the unknown and why there's a lot of angst right now in the nonprofit community as to what these things may mean to charitable giving in the future. Likewise, on the estate tax, is that with this increase in the estate tax, I think the actual exemption goes to 11 million with the inflation adjustment, right? So about 11 million apiece. About 60% of charitable bequests come from those estates that are up to $11 million in size. So if those are de-incentivized by this, how much of an impact on the charitable estate givers is going to be? The counter to all this discussion is people have more spendable income. So will they trickle it down by saying, well, I have more money left over, I can make bigger gifts because of this? So far, the studies that we've seen, past experiences, is that it will go down. Hopefully, the trickle-down concept will work and more money will be flowing to charities because of that. But what I hope is that when you're advising your clients and all, is to remind them that the charities are still doing good work in the communities. They may actually have higher demands because more people have less medical insurance and things of that nature. So it's good to advise your clients that if they care about a charity and its mission, they should continue to support that charity and its mission. The only way to do that is to write a check, settle a request, and do those types of things. So that's kind of the conversation about the elasticity and some of the rates and studies that we've seen in the past about this. Ruth mentioned briefly the Pease Amendment being repealed. This is another one of those funny things that may actually be beneficial to people from a charitable giving standpoint. As mentioned, if you hit a certain income threshold and above, your deductions were phased out for 3% of your income above that number. Well, in Michigan, I always make the argument that this wasn't a big deal because we paid 4% Michigan income tax. So if there's a 3% reduction, it's going against my 4% Michigan income tax, right? I can't get out of that income tax. But the charitable gift I did was 100% deductible because Michigan income tax was basically absorbing that, all right? Well, think of the number of clients that you have or nonprofits that you represent that have clients or donors that are from Florida or other states that have no income tax. They didn't have that Pease issue with, or protection against in the way with income tax. It did affect directly their charitable gifts. Pease would affect it and bring it down. Well, now if you're a Florida taxpayer, you can actually make a charitable gift and now worry about Pease. So you're actually going to get a little bit of a boost from making that charitable deduction that Pease used to apply to. So that's something to look at for those clients where this may be more attractive. On tax, on the 60%, so one of the questions I got is why did for 1 year, or for the next 10 years, the income tax deduction for cash contributions go up to 60%?
I think they were just throwing a bone to the charitable sector. The charitable sector was in there, very active in talking to folks on both sides of the hill, and from what I hear, had some interest in that universal charitable deduction until they gave it to the Joint Committee and the economists there who told them how much it would cost, and then the interest went away. And I think that while people are sympathetic to the sector, they're more sympathetic to the tax cut number, and this is just a sort of consolation prize. I don't think in practice, I don't find that many donors bumping up against the 50% cash contribution limit. So I don't know.
And I would say that probably, in my experience recently, I've been with the foundation for years, I know of one client that had exceeded that limit. And they had actually exceeded it for the year plus 5 years. They were going to take another charitable deduction for 8 years because of what they'd given away. But that's a very unusual circumstance where you get into that situation because keep in mind that the 60% it's cash. So most people are going to market with security gifts and things of that nature when they're making those sizes of gifts. But it is something that's out there and something that can be used. Those rules would also apply for gifts like charitable name trust and lead trust, just like in the past. So if they were to fund those with cash the deduction levels would also go up. One of the other things that I wanted to mention or have Ruth comment on, which is not directly tied to the tax law, but there was also a recent notice you alluded to on the donor advisement regs. And so can you talk a little about that and how that's going to impact either nonprofits that they represent or actually clients that they have that have donor advisements?
Actually, I think this deck has a couple of slides. I forgot about that. Let me just flip it over there real quick. Yep. That's the reference to the notice. It's notice 2017-73. This came out the first week of December, and so it might have been lost in the shuffle between Thanksgiving and Christmas and tax reform. But it is the first site of guidance about donor advised funds that we've seen out of Treasury in over 10 years. And it answers, or it attempts to give, it's a notice saying we're going to issue proposed regulations and we propose to propose some answers for you. And they helpfully gave an idea of what they're thinking about on a couple of issues that have been the most asked questions in this area. What do we do about bifurcated payments? That is, can we pay, where you have an event, right? You have the classic fundraising event, and it's a $200 ticket, and then it's $50 worth of chicken dinner and $150 that is deductible. And the donor says, I want to pay $50 and advise a distribution from my donor advised fund for the other $150. Can we do that, or is that a more than incidental benefit to the donor? There have been those, and some sponsoring organizations that have said, no, it's not a problem, because 170 says the deductible amount is $50, and he's paying that $50, and so there's not really a more than incidental benefit to the bifurcated payment. This notice says that IRS does not agree with that. IRS would say, no, that looks like a benefit to us. It looks like if you pay any amount of the payment that's required to get a ticket to the event and the donor gets that ticket and goes, that's a more than incidental benefit to him. The second issue had to do with pledges. Well, what about paying a donor's pledge? Donor has made a pledge to his alma mater. He tells Community Foundation, please, Robin, pay $1,000 to alma mater. Is that conferring a more than incidental benefit if the alma mater takes that $1,000 out of the Ruth Madrigal Donor Advised Fund and pays it and applies it to the Ruth Madrigal pledge? Well, here again, there is existing private foundation rulings that would say, in the private foundation context, if a private foundation pays the legally binding pledge of a substantial contributor, that is a benefit that would subject them to 4941 excise tax. It's self-dealing, can't do it. However, the notice goes out its way to say, well, we hear you, community. You've written in, you've come and talked to us. And the substantial contributor private foundation relationship, where there's usually one donor or one family, is not exactly the same thing that Robin's dealing with at the community foundation. A whole bunch of donors.
Reinforceable charitable pledge, which varies from state to state.
Yeah, and that's a tough question all along. So the notice says, look, we are not going to treat it as a more than incidental benefit to the donor. If the community foundation distributes an amount on the donor's advice, that the alma mater may or may not apply to a pledge if the community foundation doesn't say anything about the pledge in the distribution. Can't say, oh, it's going to pay that pledge. And the donor doesn't get any other benefit. And the donor doesn't take a deduction for that amount, even if the alma mater gives them a receipt. But double deduction is always out there as an issue.
So in summary, it's a don't ask, don't tell policy. Okay, it's literally what it says. It says if Ruth calls it up and says, pay this pledge with this pledge number, as long as we make the payment and don't reference the pledge number, and the nonprofit then applies it, it's all good. Even though we don't know about it. So it's kind of a funky little rule. So someone earlier asked me, well, does that mean that they're okay to pay pledges? And it's really no. And what it's saying is, as long as you don't talk about it, it's okay to pledge. So, in a lot of the nonprofits, when the question that got asked is, will you change your letters that go out under advisement grants? Because in the letter it says, well, by cashing this check, you're confirming that there's no no incidental or more than incidental benefit, like payment of pledge, blah, 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 blah. Well, the way I read it, it's still probably improper, except that we're not talking about it.
I think that in their heart of hearts, the IRS would have liked to have said, no, you can't pay the pledges, that's more than incidental benefit. But I think practicality got the better of this one. They realized that they don't know what an enforceable pledge is any more than any of you do. It's hard to figure out whether something's enforceable or not enforceable. It's different across all the states. And it would be really hard to set up an alternative regime whereby they could give sponsoring organizations something that they could do to ensure that they wouldn't get hit with a penalty for knowingly satisfying their pledges. So if they didn't set up this, they'd have to set up something else, and I think that pragmatically this is the right answer. There's not a lot of tax risk.
And I want to mention this, or have Bruce go a little more detail, because we get a lot of questions about this and about the our advisory grants, and people have seen this proposed set of rules or proposed, it's noticed a proposed rulemaking, and we're getting, well, I can pay my pledges, and it's not really that clear. So then the last one, which is a little more esoteric, is explaining that other issue of the advisements.
The donor.
2%.
Explain the concern. The concern is contribution monitoring. The concern is that you've got a donor that instead of just giving us appreciated property to a new charity or private foundation and taking the basis deduction, that they would give it to a DAF, tell the DAF, give it to my charity. Even though I'm still running it, if all of the support comes from the donor advised fund, it's good public support. So all of a sudden, instead of sitting on the top of a private foundation, I'm sitting on top of a PC, a public charity. I can do that. I don't have all the private foundation rules to worry about. I don't have any distribution requirements to worry about. I've got 100% public support because this property came right through that donor advised fund. This looks problematic to Treasury. And so what they have proposed in this notice is this is the abuse that they're trying to address, and they have indicated that distributions from a donor advised fund would be considered indirect contributions from a donor. So that charity, the donee charity, public charity that gets a distribution from a donor advised fund, when they're calculating their public support, and to be a public charity, I think that 1/3 public support, when you're calculating that, you only get to count amounts from each donor up to 2% of your total support. Over that, it's still part of your total support, but it's not part of your good public support, right? And what this is proposing is that any amount that comes from a donor advised fund, you look through and you see who was the donor that advised it. I'm going to add it up with that donor's direct amounts and then apply the 2% haircut. And the net effect, and then the other thing is that if it's anonymous, if it comes from a donor advised fund and it's anonymous, or if it comes from a sponsoring organization like a community foundation, and they don't say that this didn't come from a DAF, you're going to assume it came from a DAF and that it was anonymous, and you lump all the anonymous contributions together and do a 2% haircut on that. Yes, this will get at the problem. It will also get at a lot of little charities all across the region, right? Who maybe they're getting anonymous contributions, maybe they're getting support from an organization, and it's going to impose a burden to figure it out. They're going to have to be asking, did this come from a donor advised fund? If it came from a donor advised fund, who did it come from? You're going to have to aggregate things, and potentially in that anonymous bucket, that might exclude a lot of support that was previously good public support. And so some of these charities could start tipping
we send out about 3,000 donor advisement grants a year, but that's just us. So start thinking about your clients that give donor advisement support. We have to start tracking the source of the donor advisement grant by advisor. So, legal counsel or county counsel for them, this is something that they may have to concern themselves very soon if these notice rules become actual regulations in the next few months.
The other thing that was asked about, let me just do one more thing. In the request for comments, that they have requested comments on all three of these things that they've proposed, so it's burdensome. They're asking for comments on that. They've also given you a hint about another thing that they're concerned about, and that is private foundations and their interactions with donor advised funds, and when do private foundations make gifts to donor advised funds and advise them. And they're asking for comments about that too, because they're a little bit concerned that perhaps these are being used to avoid the private foundation distribution requirement. The other side of that is, I think, talking to a number of folks, is that private foundations can use donor advised funds very creatively and can be using them in ways that help communities, often to act as joint venturing vehicles. But it's not clear. And what they're asking about is, what are some of the ways that private foundations use donor advised funds that are really beneficial for our community and are not end runs around the private foundation rules? And they've asked for examples of that because I think they've given a hint that they are thinking about proposing a rule that would deny the qualifying distribution for a private foundation that distributes to a DAF unless it's flushed right through the DAF within a short amount of time. That's something they're considering. So if you have comments on that.
And I think it goes back to a comment that was made earlier that the squeaky wheels get attention with Treasury about regulations and things. And we have on the specific stuff on the donor advised funds, regardless of which way you feel, if these are good ideas or bad ideas by Treasury, we have to March 5 to make comment. So, like I've always said in these settings is, if you have an opinion on this, you need to let your congressperson know, you need to let Treasury know, because you've got till March 5 to have your voice heard. And if we don't, we're going to be stuck with whatever is provided. Whether you like it or don't like it, it's your opportunity to comment. So I want to make sure you're aware of it.
And there are instructions in that notice 2017-73, it gives an address and a person to write to be able to give comments, and those will go into the public record, and they must be considered by law and addressed.
I have a question regarding the real life situation. We have a client who has a private foundation, and every year they make their entire payout to their donor advised fund at the community foundation. And then they pretty much distribute all the money every year to other charities. They do this for the reason that they don't want to be bothered by people looking at their private foundation return on the internet and see who they give to and be bothered with all this nuisance letters. Does that become a problem?
I think if you read the notice, it looks like they are looking at a rule that would allow you to still count it if it was pushed right out very quickly. I don't know. I have heard concerns about using donor advised funds for just this purpose, for privacy and for anonymity. Some would say that that is an end run around the disclosure and transparency requirements of the 990PF. There's a couple of academics in particular, a woman at Boston University that has written about that. So Treasury has not been concerned with that as much. It's been more about the dollars and making sure that the dollars, really do go out.
And right now, what it looks like, Andrews, is they're talking about is that they would like that to be paid out in a certain period of time, and then it would be okay. And no way, I'm going to tell clients stories, but they do it on a fairly quick basis. It's not going to be an issue based on what they're talking about. So.
But what I would suggest, if there are provisions that you like, comment on those too. What was often the case when I was at Treasury, if folks didn't like a comment, you get a lot of comments on it. If there was one that they did like, they wouldn't say anything. So then there'd be one person out there from Boston who would write in and say, oh, no, we don't like this provision. And so there's one comment saying, no, that's not good. We need to ban all distributions from PFs to donor advised funds. And there were no comments saying, oh, this looks like a reasonable rule and this would allow us to help our communities. So they'd go the wrong way. So if you like provisions, make sure you say that too.
And from personal experience, I remember on a state tax law issue where I got called up by someone who sponsored a piece of legislation, and they said everybody that's lined up to testify tomorrow at the hearing is against, not one's for. And if you want this to be, so he asked them to come up and testify. It was a one yes vote, a voice in the room, and then it was able to pass out of committee and was passed on the floor. So that one voice can be enough for them to be able to move good pieces of legislation. So again, as we said, just you have a right to have a voice to express it. And
your voices are extraordinarily powerful. Let me tell you, my voice sitting in Washington, D.C., nobody's listening to me. I'm in Maryland. I live in Maryland, so I do have an elected representative. But you guys are in Michigan. And Michigan, pretty powerful politically right now. Your voices matter to your congressional representatives. Your voices matter to Treasury. You people are particularly sympathetic because you are on the ground. You guys are reviving Detroit, for goodness sake. The entire country watched as you are saving an American city. You guys have credibility. And if you take the time to write a letter, to write comments to Treasury, those count. Those really matter. If you have the time to step in. While I was at Treasury, I did not refuse a meeting with anybody ever that wanted to talk to me about a charitable provision. Ever. I never said no. Get things done right. You have a treasure in this room, Rob Collier, Michigan Foundation. You will have a treasure here. He did not pay me to say this, and at the risk of embarrassing him, I can tell you, if it were not for this person, this man being engaged and listening and saying, how can I help when it came to impact investing? We issued a notice a few years back. It's 2015-52. It's investments for charitable purposes. It basically gives private foundations the go-ahead to go ahead and make investments that not only do charitable things, but also give you a financial return and say you're not going to have to worry about jeopardizing investment tax. You can trade off a little charitable return for a little bit of the financial return, and you're okay, and draws money to charitable areas and to investments in distressed communities. That notice would not have happened but for your guy, Rob Collier, because he came in year after year and said, we need help. We need guidance that says it's okay to make these investments. What can I do to help? And he listened when I said, it would be really nice to see that in writing so that I could then attach it to an email and send it around. And the next week I got a letter in writing saying just that and giving examples from Michigan of how this actually helps people on the ground. And he came in and he talked to the Assistant Secretary for Tax Policy, and he brought some of you into the room to say, look, this is what the dollars are doing in my community. And that's powerful.
So you guys are all being a little shy today. So if anybody's got some questions, please raise the questions. And while you're thinking of one, we've got to give props back to a lot of people. Ruth wrote those regulations. Not passed, okay. And she was also on the Treasury team that helped with the city of Detroit's bankruptcy, and she doesn't talk about that either. So we also owe thanks to Ruth about all the stuff that she's done for Detroit Fast. And this is her first visit to Detroit. She's really enjoying it, so good thing. So,
You have a question?
Okay.
Yeah, welcome. We're with a nonprofit that has a small endowment at the Community Foundation. We're not a school, but if we were a school with 500 or more students, would the Community Foundation for Southeast Michigan become something that we would need to worry about with regard to that excise tax rule?
Oh, that's a really interesting question.
That's a great question. I'm not sure I know the answer.
I'm not sure I do.
Because we're not under control, we're not a supporting organization of that school, so I would think we're excluded.
I don't know. I would have
Well,
to...
now you want to make me wait, stay up all night. Okay, so thank you very much on that.
Because the question isn't just whether you come in under the technical language regulations that are promulgated.
There you go.
And so would it matter if it's third party or reciprocal transfer for the organization too? Since those are different accounting treatments?
Well, yeah, what Rand's bringing up is that there's a different way to treat gifts or endowment funds and community foundations or other charities that benefit another nonprofit based on the source of the money in the fund. So if it's from the organization itself that give it to us, it's treated as, what is it called? That's
Reciprocal transfer.
reciprocal transfers, and they get counted on the books as an asset, as a receivable. Whereas if it comes in from a donor into the fund, it's not treated on their books. So it is that another way it gets split. Yeah, we keep all the records. Well, we keep records.
I was going to say that there was some effort put in to ensure that these colleges and universities couldn't get out of that excise tax simply by putting that endowment someplace else. They went to some pains to do that, and I feel certain the Treasury would feel some authority to ensure the integrity of that tent.
That would relate to the reciprocal transfers versus third party. So we'll now have to look at that. So thank you.
That's a good question.
Great question. All right.
Question regarding QUAFs, qualified opportunity funds.
Yeah.
If an entity that already exists would qualify for a QUAF, 90% of the assets are in a qualified opportunity zone. Can you make a designation to then become a QUAF and additional purchases would then qualify as a QUAF purchase, or does it have to be a newly formed entity?
That's a good question. I don't think that, I think that's one of the questions that'll have to be answered in regs. There's not a lot of detail about the QUAFs in there. Somehow, it looks like there's some certification, and I'm not sure exactly how that occurs or who does it at Treasury.
So in essence, you have a fund already that's for an economically disadvantaged community, and then we somehow get the governor to say that community is still one of my.
Well, it's the
Well,
quads. It's the quads. The communities are designated by the governor. The funds are somehow certified by Treasury. There's some limits in there because it's intended for new purchases and things that new money. Like if it's going to be a business asset, it has to have original use and has to be purchased after 2017. But I don't think that there's anything that drills down to the entity formation. I don't see anything in there that will prevent an entity that already exists from creating a QUAF. I don't think that, yeah.
So can a QUAF benefit more than one clause?
I didn't see anything in my read that would prevent it. It talks about a QUAF having 90% of its assets in property. It has to be only one clause. It seems like it could be multiple clauses.
Here we go. Well, you did not expect to be hearing about QUAFs. Okay, so.
I have another comment. In Michigan, we need to be proud of the Council of Michigan Foundations. And I didn't really realize, I've been involved for years, but didn't know that we were very unique across the country. I sit on a nonprofit board in the state of New York, and some issue came up and I suggested that they consult with their local foundation group and found out that they really don't have one that's very effective at all. And I don't know why other parts of the country have not done what Michigan has done, but I believe that probably gives us a loud voice in Washington. Getting back to your comment.
Yep.
So you're writing this all down for your membership brochure? Okay. So.
You have a treasure here, a national level organization that's focused on your area. You guys really have it good.
Dennis?
I understand why no above the line deduction happened. You explained that quite well. I don't know anything about these 60% rules or anything else in the budget rules, etc. But if this law now in effect, and with two sides both in support of this, what would be the chances or budget rules about having a standalone change in the law for this above the line deduction?
I mean, it certainly, you could put together a bill that was a standalone bill for that, but how would you pay for it?
Well, that's what I don't know if they got 60%, does that change anything?
They got 60 votes in the Senate. If 60 of them were willing to vote for it, then yes. The challenge is the revenue loss. The revenue loss is huge.
It would add to the deficit, and I think that was the problem already. I mean, there were some Republicans that didn't like the tax bill because of the 1.5 trillion.
One of the challenges with the above the line deduction was that you have a lot of people that don't itemize currently, 70%, let's say, of the population, and they're still making charitable gifts. So if you gave them an above the line deduction, then you would see this revenue loss for them. Okay. Waxing philosophically for a minute, I've always argued that this should be an above the line deduction because it's not really a deduction. If you think about all the things that are in the charitable or in the itemized deduction section of the tax code, they're all about personal benefit, deduction for my mortgage, deduction for the taxes, deduction for medical expenses for me. It's all everything. The charitable deduction is the one unique one where it's like, here, society, have this, and I get a tax deduction for it. It's really not a tax deduction, it's really an income exclusion, right? You're taking off that deduction that you for the income that you gave away. So there's a logic to it being above the line type of thing. It's just the revenue loss will be so much bigger. But there's ways to fix that. So we actually drafted in Michigan, we sent off to Congress while this was all going on, ways in which you could limit it by having a floor. So that you can only take a certain percent, but you had to exceed that floor to say you're taking above the line deduction. Or cap. And what you cap is an easy cap. Cap is the size of the itemized or the standard deduction you take on your tax return. Because if you're going to go past that, you don't need an above the line, you're just going to itemize. Okay? But then it makes the revenue projection loss numbers look a lot more manageable, but that didn't have enough traction and a very quick turnaround with this bill. It went way too fast for those type of conversations to happen, I think.
But we can play the long game. I think that there are a number of folks thinking about, okay, long game here. The current situation is not going to be here forever. And if you start thinking about and gathering data about how this affects your community, I think you'll be in a good position to go in a year, and there may be some changes in the landscape politically, where we can start to roll back some of the worst of what's here. I would hope that over time, as we can demonstrate the costs and the impacts on the sector, that we would be able to roll back some of these things, especially things like an endowment excise tax. What is that? Well, I mean, the fringe benefit rule and the tax on fringe benefits paid. Well, that's just punitive, and the administrative cost will exceed the tax benefit in a number of cases. So, could we just roll that back a bit? Could we? And I think if we work together as a sector and thought about these rules and thought about what they do in the big picture, we might be able to develop a long-range game plan for how we could reshape these rules to help support the sector better.
As we were sitting at lunch, we were having a conversation about all these various different things going on. And we said, you know what, there's never more work to do. We're always going to be having to have these conversations about what's best for society, best for taxpayers, best for the revenue stream for the federal government things. And so this is going to be a continuing conversation. We're just going to have to make sure that we all stay involved and engaged in it and make sure that the nonprofit sector and charitable giving is continually supported. Because it's a vital part of the economy. Statistics, Rob will correct me if I'm wrong, 1 in 10, maybe 1 in 11 Michigan employees are employed by the nonprofit sector.
That's national.
And it's nationally, and I think it's approximately 5.6% of gross domestic product. Something like that is the nonprofit sector. So it needs to remain vital because they rely heavily on charitable contributions and things of that nature to be able to function. But if you have 5% of GDP go away tomorrow because all of a sudden they got rid of all charitable support.
But jobs.
Yeah, think of all the jobs. There is actually one study that this bill, as it is right now, will cost about 250,000 nonprofit jobs next year. That's a lot of jobs. We'll see. I mean, these are all these are the projections. We'll have to see what actually ends up happening. Right?
So just a couple of questions. When you talk about long range, and I think there are a lot of gaps in the Tax Act in total, not just on the charitable side. What is that time frame for us getting clarity on a lot of this? I mean, long range
Yeah.
sounds long.
And at the far end, it's never.
Right.
I mean, just
Right.
honestly. And the fear is that the taxable questions and the gaps will occupy the lion's share of the time. I think we have some very specific things, and I think if we mobilized quickly, we suggested some alternatives, and we cried out, if we got out there and squawked from all these little organizations in every district in America, it would be very quick and very easy to shut us up. I mean, these are not the most complicated provisions in this whole tax bill. And I think if we could make some noise early and loud and give some suggestions for how we would be happy to be quiet, that it could be done quickly. If we don't, then I think it could be forever until we get guidance.
And again, in this room, there's going to be a difference of opinion. If you like something, tell me you like it. If you don't like something, tell me you don't like it. I mean, you got to have. So I'm not necessarily advocating for one position or another, but we have to be engaged. So.
And I would say too, there will be revenue loss for charities. So is there a public message that the Community Foundation is working on to kind of remind people why they give in the first place?
This gets into the whole thing about grassroots lobbying versus other kinds of lobbying and all. I think that you'll see stuff where we're going to talk about the impacts, and we do have the right to talk about from a public education standpoint. This is what these things do, or the potential of those are to do. And I think we're good there, and you'll see things about that, and I hope in the future. So.
The reminder this morning was also to organizations to continue to reinforce their mission and their impact in the community. And sometimes we forget about that.
Yeah. I mean, if you look at the USA Giving studies, number one reason people give is because no one asked them. Okay. Go on and ask. Okay. But then it's because they believe in the mission. They had someone that was affected by the charity, benefit from the charity, things of that nature. Those are like the top reasons people give and support a cause, and that's because we have good hearts in America. What the studies also show is that tax policy directly affects the type of properties we give and how much we give. So it's not that we don't want to give, it's can I give $1,000 or can I only give $750? That's what this drives. But charities need to get out there and continue to talk about the importance of you as professional advisors is to remind them that charities matter as you're doing their estate plans, you're doing their financial plan or whatever, and say, if this means something to you, then you should still support it. And maybe you have some extra income because your taxes went down. So why not continue to share it as opposed to, well, hey, I'll buy a jet ski.
And corporations.
I like jet ski manufacturers, by the way, but I'm just saying, kids, you gotta make some choices.
The individual tax cuts, the impact on any particular family, it's going to be lumpy. It's going to depend on the number of children. It's going to depend on all kinds of things as to how it impacts individuals. Corporations will be generally much better off. A drop from 35 to 21% is a big drop. And, you're seeing in the news corporations that are giving bonuses to employees. Well, how about bonuses to the community that they live in? I mean, that would be, I would say, ask them. Support us. We're supporting you and your tax cut.
Bumpy stuff, what are the conversations? My deduction because it gets you over the hurdle. And then next year you don't, and then they do 2 years in the next year, you kind of cycle through your itemizing for those people that are in that area. So that's another planning technique that might be deployed more often too. Anybody else? All right, I'd like to thank you all for coming out. I know this was kind of a quick invitation. I mean, we literally did this in about 2.5 to 3 weeks, so thank you for all coming. Thank you for everything you do as volunteers on nonprofits. Thank you for serving on their boards, for volunteering, things of that nature. Thank you for what you do with your clients, for what you do personally to support nonprofits in Southeast Michigan and beyond. And thank you, Ruth, for coming from DC and seeing Detroit.